Hey everybody, Dave Lerner, Venture Studio, welcome. We've got a real treat for you today. Jeff Clavier is here in New York City. We're at Dog Patch Labs on site. He's done 99 deals. Maybe he'll do his 100th in New York City, we'll see. Jeff, welcome, good to see you.
Good to see you, thanks for having me.
I think one of the things that people would love to hear is sort of how you transitioned from being an entrepreneur, being on Wall Street, to becoming an angel investor. Tell us a little about that.
Okay, so quick background. I'm essentially a developer by training. I coded in C and C++ when I was younger. Did a startup in the financial services market back in the late 80s and spent really 12 years in finance. In 2000, moved to venture capital because I wanted to move to the Valley, and this is where I had a great opportunity. I stumbled into it, didn't plan for it. Did 4 years as a traditional VC from 2000 to 2004. Those were not the prettiest sort of years for VC. And in 2004, I started seeing this new generation of capital-efficient Web 2.0 companies that I thought were really intriguing. My partners were not really keen on those. They thought they were like not that interesting. Decided to leave and start investing my own money as a business angel. Did that for 3.5 years, invested in 20 plus companies. And because I was successful, had the opportunity to raise my first fund, which I wasn't really planning to do, but when you have such an opportunity, you just go for it. And built one of the first micro VC, seed stage firms. Softech VC2 was the brand, and raised a $15 million fund, did a bunch of investments, and essentially became one of the institutions in the early stage.
Right, you were a pioneer in this seed stage space.
There was a few of us. I would say the real pioneer was my friend Josh Koppelman, because he did the very first, first round capital back in 2004 when I was sort of a baby angel investor, and he was really an inspiration to a number of us. 2 or 3 of us sort of had a similar concept. So I was one of the first ones, but not the very first one.
But Josh back then was exclusively on the East Coast, maybe, or not?
He was traveling a lot.
Okay.
That's why his blog was called Red Eye VC, because he was traveling between his home base here and San Francisco way too much.
So Softech VC, Roman numeral 2, you raised about $15 million.
Yes.
And you've made how many investments in that fund?
So we closed 65 investments out of that one, and this fund is closed, so we are now no longer adding any new companies to Fund 2. 32 companies have already raised a total of $215 million in additional financing. We've exited 10 companies through cash M&A, through stock M&A sometimes. That's why we have some Groupon, some Twitter, some Glam Media shares in the fund. And so overall, we're really happy with the mix of companies we have.
The third fund, Roman numeral 3, is
$35 million fund, of which we filed some paperwork with the SEC talking about a $15 million close that we did back in December, and that fund has done 12 investments.
I noticed you hired Charles Hudson
a
couple years ago. He has a background at In-Q-Tel and Google. Tell us a little about Charles.
Charles actually joined me on Jan 1st. So up until December, I was actually on my own. The reason why Fund 2 was just a solo exercise is that I wanted to be able to essentially evolve my investment strategy without having to move an entire team around. So I said Fund 2 will be sort of an experiment fund on my own, and then Fund 3 is the real deal. And so known Charles for about 10 years. I met him when he was at In-Q-Tel. He's done In-Q-Tel, Google, he's done a couple of gaming companies. He's built a very successful conference business around gaming. His last company sold to Zynga, and now he's actually a venture partner with me, building a gaming company on Android and investing for Softech. So there's just a handful of guys who would be crazy enough to do a company and an early stage fund at the same time. Charles is one of them.
What are you looking for now? I saw that matrix on your website.
Yes.
It's very interesting. Tell us a little about that.
So Fund 3 is going to invest anywhere from $250 to $750 in early stage opportunities. We always syndicate with other, angels, macro VC funds, and sometimes even traditional funds. Most typically, we come in as part of a 500 to $1.5 million sort of round, which will be the first money in, most typically. People often ask, the range of valuation, so it's sort of, 4.5 to, 5.5 sort of pre-ish in this market. And we'll try and buy about 5% of the company at that time, unless we lead, in which case we'll be 10%. In terms of sectors, so we're very active in e-commerce. So we see Groupon, Living Social, a lot of vertical opportunities, so very active in that space. Mobile is definitely one of our major themes, both mobile infrastructure and mobile applications, something that we did with Fund 2, where we're investor in Tapulos, which was and still is one of the largest deployments on the platform. So we learned a lot. We're applying that in Fund 3. And the rest is really sort of SaaS, search, monetization, advertising. We really think about the world as how can we deploy our fund across a myriad of opportunities, but in a very well organized way. People see us investing in 60 deals in 3 years, and they say, it's pray and pray. You guys don't know what you're doing. And actually, there's a lot of method to our madness. And we really think about portfolio construction, about phasing, about industries in which we want to invest, so that we can deliver to our investors a sort of balanced portfolio and a balance of risk.
Let's talk a little about that portfolio. And now it seems like when you've done 99 investments, you start to play chess at a much higher level. You're starting to make sort of arrangements for your companies, for their exit strategy, looking at the whole life cycle. Tell us a little about what playing chess at that level is like, what you're doing.
When you're going to commit to a company, the first point of discussion you have with the CEO and the team is, how can we help you with our resources, our network, or expertise, the few things that we've learned over the years, and how can we sort of bring in a set of complementary investors so that we build this foundation of support that will really help you get to the next level. And for most seed companies, we're really talking about roughly 18 months of runway. That's what the seed round is for. Building the product, getting it to market, and essentially proving to the next round investor that what we have is actually really worthy of a more traditional sort of Series A, $3 to $5 million. And so everything we do is aimed at hitting those milestones that will get the company to the next level. That might be helping with business development, that might be sort of pimping the company on TV, that might be sort of making some business opportunities available to them. So in our business, there's no pride, right? We basically do whatever it takes to help our companies.
You heard that here, there's no pride in this business. On the acquisition side, I'm sure you've made a lot of inroads over the years, right? This is your 6th or 7th year in doing this straight. Yes. Tell us a little about that.
So we've had 17 exits. And so you learn a few things here and there. And typically you don't really sort of talk about those things, but at every point in the execution of the company, the entrepreneur will be faced with the choice of either continuing or positively answering to, hey, how about an offer at X? And so it has to be sort of a seamless process where, as an investor, early stage investor, you're very aligned with the entrepreneur. You want to be, you have to be. And so if they say, and it happened to me a number of times, look, I know we could go to several $100 million of value, but that offer on the table is actually bringing me, 10, 15, $20 million in my personal pocket, me and my co-founders, and we'd love to take that. And even though you have the legal rights to go against it, you will sort of make them aware of your position. You will sort of say, hey, if I was you, this is how I would look at the opportunity. And yes, there is this get the money in now or later. But at the end of the day, you present the facts to them and you help them find potentially alternatives, a better deal, negotiate on their behalf because you've done this quite a few times, but always support what they want to do ultimately.
Have you noticed some network effects amongst your portfolio and how that has affected things?
So we have 60 plus active portfolio companies. So people who are still in the portfolio that we help on a daily basis, weekly basis, monthly basis, depending as to how long they've been around. And there's always this opportunity for us to bring the younger companies to the more mature ones, saying, go talk to this VP of Biz Dev there, or meet the VP of Sales, or talk to that CEO base, because whatever is done over the last year is very relevant to you. So you get a lot of network effects across the portfolio. What we don't do though is build that Kuratsu thing that was very popular 10 years ago, when you were like buying, investing in this company that was selling to this company, which was, buying from this company. No, we don't do that because it's just not the way you build a portfolio. It's just too risky.
You're here in New York City. You're
Yes.
very active in New York City. You're doing
Yes.
a lot of deals in New York City. You're in AdStruck, you're in Chartbeat, you're in many companies.
Bitly.
Bitly and others. Tell us a little, tell us a little about New York City, what it means to you, and why you spend so much time here.
So I've actually spent a lot of time personally in New York because in my previous life, when I was selling to the financial markets, obviously Wall Street was the #1 market. I actually had we did an acquisition in New York, so I spent a lot of time here. But as an investor, typically, especially on the angel side, you say, well, I have to be able to drive to my investments, right? Because you want to be, face to face. If ever there is a problem, get a call, you're there. And so I can tell you that New York is just, a few hours away driving from Silicon Valley, because now there is a lot of things happening in New York that are really interesting. And I basically said no to New York until FanBridge dragged me to just say, okay, I can't pass on that deal. I will do it. And as I was spending more time here, I got the opportunity to invest in Bitly and a few others. And because you're spending time, you're meeting with entrepreneurs. And so you have sort of the positive network effect of discovering opportunities. And now our strategy is stated, which is 80% Silicon Valley, 15% New York, and the rest of the 5% we'll figure it out.
Challenges. What are the biggest challenges and sort of obstacles for you as an investor?
There's really a number of things. One is, are we seeing all the companies that we should invest in? Is there a deal flow, some pockets of deal flow out there that we don't see? And the answer is these days, we have a pretty optimal deal flow. There's always like a few deals that we might want to have seen, but pretty much we're very happy with the access we have. The big challenge is to just go through the execution of the first 18 months of the life of a company and try and avoid screwing it up, because you might have a fantastic team, you might have a great product, you might have a real market opportunity, but screw it up. So good old execution and figuring out how we can help and sort of avoid traps and pitfalls without being over the shoulder of the CEO and the team, because we can't and they don't want us to anyway. And then as the company scales, still figuring out how you can transition your help from the initial sort of support to the scaling support. Many people sort of consider that once you're at $10 million in revenue, 50 people and so on and so forth, it's sort of easy. No, it's not. You can actually screw it up. We've had, unfortunately, a couple of companies that went to $20 million in revenue and crater. So figuring out how best you can support your entrepreneurs along the way as they get to maturity and eventually escape velocity is our day-to-day challenge.
An average day for you must be completely varied. You must be looking at many deals, you must be helping your portfolio companies, tell us a little about an average day in your life.
Average day starts around, so either 5 or 7 a.m. Try to spend a bit of time with the kids, do a bunch of emails. Day starts in the office at 8 a.m. and it lasts until 7, 8, 9, sometimes more. Mix of helping, supporting companies, so catching up with CEOs, deal flow, so meeting new companies, looking at opportunities. As I said, 10 to 30 come to us a day, roughly, of which 2 to 3 will get sort of a meeting, and eventually we'll filter that down to 2 deals a month. There will be a lot of interviews. There will be a lot of public speaking. There will be a lot of interactions that will help the portfolio, because by being on this kind of interview, I can pimp a couple of companies. This will sort of bring deal flow. It's always very useful to establish the brand for us.
Right.
And so it's very diverse.
Jeff, it's a pleasure to have you. This is one of the hardest working guys in venture capital and early stage investing. Thank you so much for coming on the show.
Thanks for having me.
Great to have you.
Cheers.